What's going on, everybody? Thank you so much for checking in. In this video, we're going to talk about what makes up an option contract's value or premium. And the reason why this question is so important to answer is because many traders will run into situations in which they will buy a call option on a stock. The stock proceeds to go up, however, the option does not move up with it. And the reason why is because of the two pieces that make up a total option's value, and that is the intrinsic value and the extrinsic value, and we will dive into more detail about the extrinsic value in just a little bit. But first, let's explain the intrinsic value, which is pretty straightforward, which is the portion of the option value that is directly related to the underlying stock's price. So imagine that the extrinsic value does not exist and we haven't talked about it yet. The intrinsic value is directly related to how the stock goes up or down. If you're in a call position and the stock goes up, then the call will go up with it and you will make money on that call, and vice versa for puts. Now, the extrinsic value, on the other hand, is made up of a few portions, those portions being time till expiration and implied volatility, as well as interest rates. But for the focus of this video, we're only going to talk about time till expiration and implied volatility. And so now we're going to pull up an option chain, and we're going to use Apple's option chain because that is a good stock to use. And don't worry about the dates. Even if you're watching this video later in time, this will still apply to everything you're learning. First of all, we want to focus on something called theta, and then we also want to talk about something called implied volatility. And both of those are available here on my option chain. You don't have to use Thinkorswim for this. However, Thinkorswim has a pretty clean layout where you can see everything right in front of your eyes, and it's pretty straightforward to see. And so here in this case, talk about theta, which is the first part of your extrinsic value. And so the further you are away from expiration, the more extrinsic value your option contract has. Let's explain into detail. Right now, these contracts that we're talking about here are contracts that expire in the same week that we are making this video. Therefore, theta is extremely high, and most of the time till expiration premium has already been burnt off. There's only about 3 to 4 days left before these options expire, and so every day that you're holding closer to expiration, you are losing that theta, otherwise known as time decay. Now, time decay in this case is going to be right around 42 for this specific contract. So if we take the 172.5 contract and we hold it till tomorrow, then about $41, all we're doing is multiplying this number by 100, then about $42 to $41 will be lost if we just hold it one single day. And that is because that's what theta represents, and theta is a part of your premium of the option. So theta is part of your extrinsic value. Now, the reason why closer till expiration contracts move a lot faster is because the extrinsic value has been pretty much drained from them, and all that's left is going to be the intrinsic value. So the stock or the option for the stock will move very tightly with the underlying stock's move, which is what makes 0 days till expiration or 1 day till expiration options so popular amongst traders, is because they do not really rely anymore on extrinsic value. They are solely reliant on intrinsic value, which is directly related to the stock's price, and the extrinsic value has been almost drained. Now, another major part of extrinsic value and part of your option premium is going to be your implied volatility. Now, implied volatility is always measured in a percentage, and you can see here on the implied volatility for Apple, it's going to be right around 30%. A healthy implied volatility is typically between 30 and 60%, but that depends on stock to stock. Sometimes it's a little bit higher for specific stocks, and sometimes it's a little bit lower for other stocks. But typically, your healthy implied volatility is going to be anywhere between 30 to 60%. But before we jump into further explaining implied volatility, I want to show you something on theta that we missed on the first part. So theta here on this expiration, which is this week, is around 42 for calls that are at the money. Now let's push it out a little bit further to November 17th, and you're going to see theta drops dramatically. You see that theta goes down to $13, which means that for every day you're holding this contract, which is the same exact contract, just a further expiration, it drops from about $41 to $13. And that's because you have so much more time. Here in this case, there's over a month or about a month till expiration. Therefore, theta goes down and time decay also goes down. And it's not as severe from day to day that you are losing option premium. Now, as you get closer to this expiration, or as you get closer to any expiration, that theta number begins to go up and your losses per day begin to go up because of that time decay. But there are a lot of other moving parts that will make up the option premium. So now let's talk about that implied volatility and talk about what implied volatility does to your option contract. So implied volatility measures how large of a move that the option or the market expects from the underlying stock. So here in this case, the market is expecting about a 30% move in the underlying stock, and that doesn't necessarily mean that Apple will go up 30% or down 30%. There is an entire formula to measuring what it actually represents, but Thinkorswim and a few other platforms actually make it pretty easy. And if we just go up here and look at the top right of every contract, we can see that the implied volatility here is an average of 33%, which translates to about a $3.40 move. And so before the expiration, or by this expiration, here in this case it's October 25th, so in the next 2 days, the option market expects Apple to either go up $3.39 or go down $3.39. Now, why is this important? It is important because implied volatility, the higher it gets, the more inflated that option premium becomes. And so if an implied volatility is trading around 100%, then the contract price is going to be much higher because implied volatility is a part of your extrinsic value. Now, how does this impact earnings? I'm going to go ahead and show you. So here in this case, let's look up Visa stock. Visa just reported earnings today, and although the stock is up about $2, you can see that the stock's calls are actually down anywhere between 39 to 40%. So many people are wondering, okay, so I bought calls, the stock went up, why are my calls losing value? And that's because the implied volatility got crushed. Anytime before an earnings statement, implied volatility typically goes up on any stock. And so let's take Meta, for example, which is set to report earnings when we're making this video today after market hours. And so we're going to go ahead and go to Meta's option chain, and we're going to see that implied volatility on Meta is roughly around 155%, which is a very high implied volatility. And you can see that Meta's contracts are extremely expensive. Now, knowing what we know about the expected move, let's take a look at what markets are expecting from Meta, and you can see that they're expecting a $27 move on its earnings. Nobody knows if that's up or down, and nobody can guarantee that Meta can actually go up or down. So in this case, if you're buying this contract and it expires the same week, and Meta does not move by at least $27, then this implied volatility is going to get crushed from the 155% all the way down to about 30 to 40%, which will take the option premium down with it, even if Meta continues to go up in your desired direction. If it does not move as much as $27, these contracts will lose most of their value by the time expiration hits. And we're actually going to take this Visa contract here, we're going to copy it, and we're going to see what it was worth yesterday. And you can see that yesterday it was worth about $365 at its highs. And in this morning on its open, because of that implied volatility drop, the contract dropped from that 365 high to a low of $47. And implied volatility is yet to recover back to that 100%. In fact, it is very unlikely to recover. So anytime you are playing earnings, or anytime there is a large report expected from the market as a whole, you're going to see that implied volatility is going to go up, which is something that's so important to pay attention to. The closer you are till expiration when it comes to those reports or key earnings, the higher that implied volatility goes. So here in this case, Meta is set to report earnings this week, and this week ends on the 27th. Implied volatility is going to be very high for those expirations on both calls or puts. But if you push it out a little bit further to November 17th, which is about 20 days away, you can see that implied volatility drastically drops. But now you're paying more because you have more time till expiration. And so that's why you'll see that premium continue to go up. But that implied volatility can have less of a risk or less of an impact because the implied volatility has less value of the overall premium. Remember, the overall premium is made up of the extrinsic value and the intrinsic value. Both the time till expiration and implied volatility go into the extrinsic value. So I hope you guys found this video helpful. I tried to make it as quick and simple as possible. Thank you so much for checking in. Don't forget to subscribe and like.